Hello, everyone, and welcome to the IBKR Podcast. In this special episode, the 2025 intern class will be leading the discussion for a thoughtful conversation on climate risk in financial markets. We're pleased to welcome Michael Penn of ASR Research, who will be a returning guest to the IBKR Podcast. So without further ado, I'll pass it off to Rishi and Kwame to kick off our questions.
Good morning, Michael. I'm Rishan. I'm with the securities lending team. So to start off, how would you say climate-related tipping points like rising sea levels or extreme weather conditions alter the risk of, let's say, calculations for large exchanges and different kinds of market participants?
Sure, yeah, thanks, Rishan, and thanks for having me back on the podcast. So in regards to climate tipping points, I guess it's worth understanding first what a climate tipping point is. So a climate tipping point is it's a critical climate threshold beyond which environmental systems undergo some kind of irreversible damage. So it's a change in the kind of environmental system. It's irreversible, and those changes tend to be kind of self-reinforcing. So some of the best examples of this, often you hear things like the ice sheets of Greenland or Antarctica. If those collapse, that will create a surge in sea levels. Or another common tipping point that people focus on is the potential dieback of the Amazon rainforest. So if the Amazon rainforest were to die back, that potentially means we lose a very valuable global carbon sink. And so even more carbon emissions released into the atmosphere, and that then accelerates climate change. Now, that's a big risk for economies and markets. So there's some recent analysis, I think this is 2024, that said that about $58 trillion of global GDP is somehow dependent on nature and nature's services. So you should be thinking about things like fresh water, pollination, timber, fisheries, and so on. So $58 trillion, I mean, that's more than half of all global economic output. So hitting some kind of climate tipping point certainly would have a very big impact, I think, on the global economy and on markets.
Hey, Michael, I'm another intern, Kwame, with the sales team. And continuing that thread, what is the tipping point for average global temperature, thresholds beyond which the damage becomes nonlinear and affects billions of people, biodiversity, and weather volatility?
Yeah, thanks, Kwame. It's a good question. I mean, I guess the scientific consensus would say that if global temperatures move above 1.5 degrees Celsius, above the pre-industrial level, then we could start to hit some of those kind of tipping points that you referred to, and damage to the environment could accelerate. So just a little bit of background on what 1.5 Celsius means. So a rise to 1.5 degrees Celsius above pre-industrial levels means that the Earth's average surface temperature is 1.5 degrees Celsius warmer than it was prior to the Industrial Revolution. So that's around 1850. So that's equivalent to about 2.7 degrees Fahrenheit warmer. And the worry here is that we are very close to hitting that 1.5 number. In fact, last year, the global average temperature was 1.6 degrees Celsius. Now, that might end up being temporary, just a temporary move above 1.5 degrees, but certainly there's a lot of concern that the temperatures are accelerating much more quickly than the scientists had expected. So, in answer to that question, 1.5 is the number that everyone's very focused on.
Thanks, Michael. And just trying to, again, going off on a bit of a tangent, I was kind of wondering, how would you say climate risk contributes to persistent inflationary pressure, like over the next decade? Like, how would you say that kind of looks like for the next 10 years or so?
Yeah, sure. I mean, I guess there's a couple of primary ways through which climate change can impact inflation pressure. One of them is via food, and the other one is via supply chains. So if you think about food, there's a very obvious link there. If we have more droughts, we have more floods, that can wipe out harvests, and it causes the supply of agricultural produce to fall. And if the supply suddenly drops, then prices tend to spike. And if you see that those events with increasing frequency, then the increased prices can become more sustained and then therefore lead to inflation. I think the other indirect link, which people often maybe don't spend as much time thinking about, is the impact on supply chain. So I think probably the best recent example of this is what happened with the Panama Canal. So a couple of years ago, I think this is in 2020, the end of 2023, the lake that feeds the Panama Canal fell to a 60-year low, and that was because of a prolonged drought in Panama. And because the level of the canal was lower, it restricted the size and the kind of volume of ships that could travel through the canal. Now, the Panama Canal plays a really important role, not just in global trade, but particularly the shipping of agricultural food. So climate change is not just about the direct impacts on agriculture and sort of supply shocks there, but it also can disrupt shipping and transport, and that can push up prices as well.
Thanks, Michael. And I know you've hit on the economic impacts of climate change, and I'd love to hear more about how you think about the size of the economic consequences of climate inaction for consumers, government, and economies alike.
So, yeah, I mean, inaction it's a good question. I mean, I think the starting point is to say, well, if we assume that we do nothing and global temperatures continue to rise, what does the world look like 20, 25 years out from now? And there's a lot of economic and sort of scientific modeling to kind of try and project these things all the way out to the year 2100. And under some of those more severe sort of scenarios where we really don't do anything, the impact of physical climate change could be quite significant. I mean, notwithstanding some of the tipping points we talked about, even separating from that, the expectation is that under a kind of business as usual scenario, we could be talking about taking maybe 20% off the level of annual economic output by 2050. That's really if we don't do anything. Now, of course, the best way we can prevent some of that, the worst consequences, is if we can bring down greenhouse gas emissions today. But in order to do that means kind of changing the way that we consume energy, shifting from fossil fuels to clean sources. It means changing how we think about pollution. It probably means paying more to fly or to drive, to travel, and paying more if we choose to burn fossil fuels rather than opting for clean energy. And I think there's the kind of fundamental problem, coming back to your point about inaction. The problem here is that changing how we live today costs money. And in order to change the kind of the costs of physical climate change in the future means paying some kind of upfront cost today. And so we have to be kind of very forward looking and I guess kind of altruistic in how we view future generations and say, I'm willing to take the cost on today in order to minimize the long-term cost. And the problem there is, of course, with all of the current issues in the world, whether it's the cost of living, increased focus on military spending, the cost of healthcare, it's very hard to get people to prioritize something today, which feels like the worst consequences are a long way away. And that is really where governments, I think, have to play a much greater role in sort of intervening and trying to sort of change the shape of that burden and try and shift it and sort of make people much more aware that the consequences are coming down the road.
So we've discussed the broad economic impacts of climate inaction. So let's focus on how specific financial institutions are responding to these challenges. So Michael, how might central banks incorporate climate-related risk into their monetary policy decisions?
Well, for central banks, I mean, I think they face quite a tricky balancing act because, we talked already about some of the physical impacts of climate change, and that's going to create inflation impact. So we're thinking about how central banks are focused on the shocks that come from food supply or supply chains. And so that's going to tend over the long run to push inflation up. But on the other hand, these climate shocks, if you think about floods or droughts, they're likely to depress economic activity. And that means lower economic growth. So central banks, what the question for a central bank is, what do I do when the inflation risks are building and rising because of climate change, but the growth rates are being pushed down. What do you do when you've got higher inflation and lower growth? Do you raise interest rates or do you cut interest rates? And that's a kind of a challenge that a lot of central banks are grappling with, probably more in emerging markets right now than they are necessarily in developed. But one new idea being floated is something called adaptive inflation targeting. So in kind of plain English, adaptive inflation targeting is just saying that central banks should be adding tolerance bands. So that would allow a central bank to be comfortable with inflation fluctuating between 1% and 3%, for example, rather than being fixated on a 2% inflation rate. So if they were to move towards some of these kinds of new concepts, it might give central banks a little bit more breathing room to cope with unexpected shocks, like shocks to food supply or weaker growth. So these are just some of the new ideas that central banks and kind of monetary policymakers are considering as climate risks are starting to build.
Hi, Michael. My name is Tyler. I'm an intern from the institutional services team. And my question for you today is, do you think that the market is correctly pricing in the shift from fossil fuels to renewable energy in their risk models?
Yeah, thanks, Tyler. It's an interesting question. What does the academic evidence say about companies and sort of the energy transition? Are companies which pollute more or rely on fossil fuels, do they trade differently to cleaner companies? And you could actually, I guess you could extend that question to sovereign debt markets. Does the sovereign debt of a country like Saudi Arabia, that's very heavily reliant on oil revenues and potentially is at risk if we see a faster transition away from oil to clean energy, does Saudi Arabian debt trade differently to the debt of a country which has already started to shift to clean energy? The evidence here actually is quite mixed. There's no clear evidence one way or another that cleaner companies trade differently to dirtier companies, or the same for governments. And I think that's because it's not really clear yet how quickly the energy transition will take place. If we were to see if the market was confident on a very quick, sort of orderly energy transition, yes, some of those companies or countries may suffer. But governments have been giving very mixed signals. A couple of years ago, we had the Inflation Reduction Act, and that seemed to suggest that America, for example, was on a clear path to decarbonize, and then the Inflation Reduction Act, the US pulled away from that. And we've seen similar pressures in Europe, where a lot of European governments have stepped away from some of their stronger sort of climate commitment. So governments are giving these kind of mixed signals. And so likewise, I think markets are not necessarily betting on a faster energy transition. So it's not really clear that there's a difference in the way that markets price, let's say, clean companies, dirty companies. But I think one area where the academic evidence is clear cut is on how markets look at physical climate risk. So we're talking about things like the impact of floods or droughts or wildfires and how that impacts assets. Companies or countries which face higher physical climate risk do tend to see market prices reflect that. So thinking of sovereign debt, for example, if you're an emerging market, a developing country, which is potentially in the firing line of the worst physical climate impacts, you do see debt bond prices reflect that increased risk. So certainly on the physical side, yes, but on the energy transition, the evidence is still quite mixed.
So hi, Michael. My name is Rishi. I work with the HR analytics team. And my question is, so considering sectors like infrastructure and agriculture, which one do you think is more exposed to climate-related risks in medium term, and why?
Yeah, so climate, I guess it comes back to Tyler's question about sort of how we think about climate risk. I'm going to focus maybe more on the physical. In answering that question, I'm going to think more about the physical climate risk, because that's the area where I guess we're more confident is going to unfold. You mentioned agriculture. I'd agree with that. I think agriculture probably has the biggest exposure of any sort of major sector. But even within agriculture, the exposure can vary. So we think products like coffee or cocoa, much less resilient to physical climate change. And so prices can move around a lot, certainly a lot less resilient than other agricultural products like grains or some of the softs. So I think of things like wheat or corn, which tend to be produced in countries that have better adaptation, better resilience. So prices for those products doesn't tend to vary as much, doesn't tend to be in the firing line as much as things like coffee or cocoa. I think you're right to identify infrastructure. If you think about infrastructure assets, these have fixed locations, very long lifespans, makes them very vulnerable to some of these slow burn physical impacts. So think about things like water stress or storms or wildfires. These are big risks for utilities in particular. The other sector I think I would probably flag is real estate faces risk. Now, part of that is direct physical damage. You own a beachfront property, you're going to have direct physical damage, and that's going to cost you a lot of money. But of course, there's also indirect costs, things like higher insurance costs, or if people anticipate insurance prices rising, maybe the property value falls. So real estate really is a kind of almost a canary in a coal mine so as we think about some of these physical climate risks. And we've certainly seen this unfolding in the US. There's certain insurance companies which have withdrawn the availability of insurance. I think about Florida or California. Some insurance companies will not offer property insurance because of climate risk in those states. And so that can have an impact on property values. So, real estate, infrastructure, agriculture, I think those are the three big sectors to be watching.
Hi, Michael. My name is Zach. I'm an intern with the Learning and Development team. My question is, are markets becoming increasingly desensitized to geopolitical and policy uncertainty?
Yeah, hi, Zach. Yeah, I think, yes, there probably is some sign of, I guess, what I'd call uncertainty fatigue, if that's a term. There's no question that these kind of higher levels of policy uncertainty have become a lot more normal now. Maybe that feels like an oxymoron to say policy uncertainty is normal, but we're getting used to, the markets are getting used to this sort of much more volatile environment. But I think also if the economy is strong, I think if central banks look ready to cut interest rates, if the uncertainty were to rise too much, sometimes those sorts of factors can be a kind of a cushion against the uncertainty. I think the problem is when some sort of vague or uncertain risk becomes very concrete, then markets can still shift very rapidly. So you think about the tariff announcement in April, very good example of that. No one expected the tariff increases to occur. We saw an announcement, and suddenly we saw a 10 to 15% overnight sort of drop in US stocks. So that was seemed like a very credible threat. Then there was a back off and a very quick rebound. So yes, I think there's certainly some elements of evidence that markets are kind of becoming desensitized, but we can never discount the idea that when a threat becomes realized, markets will react very suddenly.
Well, to wrap things up, thank you for tuning in to this special edition of IBKR Podcast. We'd like to thank Michael Penn for his insights and time, and our interns for their thoughtful questions. Be sure to subscribe to IBKR Platforms podcasts on your preferred platform for more conversations on markets, trading, and global finance.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.